Hello financial buddies, I'm Crestile and welcome back to my YouTube channel. Today we're going to discuss regarding financial statement and financial health. The balance sheet provides a snapshot of an organization's financial position at a specific point in time. Whether you're managing a hospital, clinic, or healthcare facility, understanding the balance sheet is crucial for decision making. Assets represent what the organization owns, such as medical equipment, supplies, or real estate. Liabilities are what the facility owes, including debts to suppliers or outstanding loans. The difference between the two is equity, which reflects the net worth of the organization. In Canadian healthcare context, this balance sheet can highlight whether a public hospital is financially stable or if a private clinic is well positioned for expansion. Reviewing these figures gives insight into whether the organization can invest in necessary upgrades or needs to cut costs to remain viable. Next, the income statement shows how profitable the organization has been over a particular period, often one fiscal year. In healthcare, this document is essential to determine whether the services offered, like specialized care or elective surgeries, are financially sustainable. Revenue comes from various sources, such as patient fees, government funding, or insurance payments. Expenses, on the other hand, include staff salaries, medical supplies, and facility maintenance. By subtracting expenses from revenues, we arrive at net income. Basically, whether the organization has made or lost money. Understanding this helps healthcare administrators ensure that the clinic or hospital can continue to provide quality care while remaining financially sound. The Statement of Retained Earnings is another critical document. It shows how the organization's cumulative profits have been reinvested over time. In healthcare, retained earnings might be directed toward upgrading medical technologies, expanding departments, or building new facilities. For example, a hospital in Ontario may retain earnings to invest in a cutting-edge radiology department, improving both patient outcomes and the hospital's market position. Retained earnings can also be used as a buffer for unforeseen costs, such as the need for additional resources during flu season or an emergency pandemic response. The cash flow statement helps managers track the flow of cash in and out of the organization. In a healthcare setting, this document becomes critical because healthcare organizations often face delays in receiving payments from insurance companies or government reimbursements. These can impact daily operations, from paying staff to keeping essential medical supplies in stock. The cash flow statement breaks down cash flows into three categories. 1. Operating activities. These everyday operations such as patient fees and payments to suppliers. Number 2. Investing activities, buying new equipment or investing in facility upgrades. Number 3. Financing activities such as loans or issuing bonds to fund large projects. For healthcare administrators, ensuring that the organization has enough liquidity to cover operating costs is crucial. A positive cash flow means the organization is financially healthy and can reinvest in growth areas. Financial ratios serve as powerful tools to assess the financial health of any organization, including healthcare facilities. Let's break down a few key types of ratios and how they are used. Operating efficiency ratios measure how well an organization uses its resources. For instance, how efficiently is a hospital utilizing its medical equipment and staff? A higher efficiency ratio indicates that the hospital is maximizing its resources. Liquidity ratios assess an organization's ability to meet short-term obligations. A hospital with strong liquidity will be able to pay its vendors and staff without delay, which is crucial in healthcare, where operational disruptions can have severe consequences for patient care. Solvency ratios evaluates the organization's ability to meet long-term obligations. This might involve assessing whether a hospital can handle significant debts from building expansions or upgrading technology over the years. Profitability ratios determine how well the organization generates profit from its services. A healthcare facility might use this ratio to decide whether to expand its offerings, such as adding specialized services like cardiology or oncology. Financial ratios can be particularly useful when making investment decisions. For instance, an investor might look at the price to earnings (PE) ratio to determine whether to invest in a Canadian healthcare company listed on the Toronto Stock Exchange. A lower PE ratio might suggest that the stock is undervalued and presents a good buying opportunity, whereas a higher ratio could mean the stock is overvalued. For lenders, financial ratios are equally important. A bank, for example, might use the debt-to-equity ratio when deciding whether to approve a loan for a healthcare facility's expansion. If the ratio is too high, the bank may see the facility as a high-risk borrower, which could affect the terms of the loan or whether it is granted at all. Financial ratios also come in handy for forecasting future needs. For example, a healthcare administrator might use the inventory turnover ratio to estimate how often medical supplies need to be restocked. If turnover is high, it means supplies are being used quickly, and the organization must plan to maintain a steady flow to avoid shortages. Lastly, financial ratios are valuable when making business decisions. For instance, a healthcare organization may use profitability ratios to determine whether to expand into new services or open additional clinics. If the ratios show strong profitability, the organization can confidently pursue growth initiatives. To summarize, financial statements like the balance sheet, income statement, and cash flow statement, combined with financial ratios, provide a comprehensive view of an organization's financial health. For healthcare managers and decision makers, these tools offer the insights needed to make informed decisions, ensure sustainability, and most importantly, continue providing quality care to patients.